Okay, guys, a very good morning, afternoon, and evening to all of us here. Many thanks for taking the time out of your day to be with us. So, in previous webinars, we covered Forex basics in two parts, and last week nosedived into the basics of technical analysis. We covered a brief history of TA and the basics, basic principles of TA, namely the trend, where I looked at basic trend structure, including retracements and pullbacks. We also stepped into the world of chart patterns and candlestick formations, looking at flag and pennant patterns, and also two widely used candlestick configurations, the hammer and shooting star. So right now I'm seeing little conversation going on in chat. So I guess I'm coming across loud and clear, and the welcome slide is visible. So if not, please feel free to let us know in the chat box, and the support team will assist where they can. Okay, so now today's presentation is it's all about support and resistance, which is the backbone of many active trading strategies today. Guys, can I ask how many of us here actually use some form of support and resistance in their trading? Also, it'd be good to know what your experience has been so far. So please go ahead and type any replies in the chat box, guys. That would be fantastic. So, okay, we have a couple of us every day. Excellent. We have a couple of us here noting that they use SR regularly, and with some stating they prefer objective levels such as round numbers, pivot points, and also moving averages. This is great because as we'll be briefly discussing MAs in this presentation. So for me, at least, support and resistance is not, how can I put this, is not a fixed strategy where you only have one way of determining support and resistance. There's several forms of support and resistance. I've personally found some approaches perform better than others, though often a filter is needed to avoid whipsaws that can, and often do occur. Excuse me. So ultimately, this webinar is geared towards newer traders, just getting their feet wet, but I sincerely welcome all traders of all experience levels. A recording of this presentation will be available, which can be found on FPM's website or on FPM's YouTube channel. Support will also send out an email after the webinar ends with directions regarding a recording. As usual, just let me run through the disclaimer on screen before we move forward. It basically informs viewers that information presented in this presentation is intended for general advice only, and none of it should be relied upon as personal advice. FP markets do not take into account your investment objectives, financial situation, or particular needs. So ultimately, what we discuss in this webinar should not be considered as investment advice. So for those not present in previous webinars, I'll just quickly run over who I am, so you know who's on the other end of the mic, and I'll briefly introduce topics of focus for this presentation. So my name's Aaron Hill, and I'm part of the research team at FP Markets. I've been involved in the financial markets since about 2010. In terms of qualifications, not that these are really required to become a trader, I might add. So I've completed CMT levels 1 and 2 and enrolled on level 3 this year. I also recently received the CFTE qualification in 2020 from IFTA. For anyone interested in technical analysis, the CMT program I would wholeheartedly recommend. It is quite intense, but it really opens your eyes to the broad range of technical concepts that exist. It's really quite amazing, to be honest. And as for trading, for me personally, I like to keep things as simple as possible in my approach, adopting concepts such as price action, Fibonacci, the relative strength index, or RSI, as it's more commonly known, and most importantly, chart psychology. We have plans to go over these subjects in future webinars, from beginner to advanced. Also, please feel free to check out FPM's Trading Hub. It's a place that's it's packed with educational content and daily analysis using fundamental and technical analysis. As for presentation topics, 4 subjects are on the radar today. Support and resistance defined being the first. Support and resistance, or often referred to as SR, is one of the most talked about concepts in technical analysis. So here I'll attempt to define what we mean when we talk about SR. This is great for newer traders. And then we'll shift to types of support and resistance. Although the definition of SR remains the same, irrespective of the approach, traders, especially newer traders, can become overwhelmed with the with a sheer number of SR strategies available. While it's beyond the scope of this webinar to go into detail regarding each approach, I'll cover as much of it as I can to try and give beginner traders shall we say, a stepping stone. Excuse me. We'll then move on to how to plot support and resistance levels. As I'm sure you can appreciate, there are several ways to apply SR. For me, there's no right or wrong way. So here I'll highlight a few common examples of how traders approach applying SR to the charts. And finally, multi-time frame support and resistance levels. I was not sure whether or not to add this to the presentation through fear of confusing newer traders. But it's such a handy method to understand, and I use it daily in my market analysis to ultimately guide trading direction. Some traders will use multi-time frame analysis differently, and that's absolutely fine. But what I'll do is I'll show what I look at, and hopefully you might be able to take something from it. Also, ladies and gents, after this we'll take any questions if they arise. We all started off as beginners, and to me there's no silly questions. In fact, study of the markets is never ending. So we're all still technically students of the game. So yeah, basically, please fire across any questions. Any questions I'm unable to get to, or if there was a point you thought I should have covered, please let us know at marketanalyst@fpmarkets.com.au. Please also use this email to request any future webinars you think may benefit traders. Right, now, let's jump into the first topic of the day, the definition of support and resistance. So a support level, going on my definition, is simply a price level that has shown buying interest. Think of it as a floor that has withstood downside attempts multiple times. To me, 2 or more tests are of the same level is required to consider this as a support. Some will argue that the first bounce is considered support, and that the second point is likely to hold. As I said, there's no right or wrong here, just different traders have different perspectives. However, major support levels are often those that have welcomed numerous tests and held. Minor supports generally have little history. Resistance is simply the mirror opposite of support. It is a level that has demonstrated interest from the sell side of the market. Again, 2 or more tests would be required for me to consider it to be a valid resistance. Let me just spin things over to a chart to better help demonstrate what I mean as, as the pre-drawn examples they can sometimes be a little misleading and not really echo real life scenarios. So on the slide, we have the euro dollar daily charts, and we have 2 points of support, or two bottoms here. So when, or indeed if the pair returns to this point, we could actually see a reaction form, as this was an area where buyers were active in the past. In fact, for those who follow chart patterns, you will note that this was a near textbook double bottom pattern, which worked out beautifully. Ultimately SR levels. So right, hold on, resistance. So resistance. So we can, as for resistance, we can see a level formed around, I believe, the 1500 base. This is not as clear cut as the support example in terms of structure, as you can see, price actually whipsawed above the level around this point here. So SR levels exist as a product of, shall we say, supply and demand. If there are more buyers than sellers, price should rise. If there are more sellers than buyers, price tends to drop. Just to further emphasize the point of floors and ceilings on the chart, we can also have resistance posted here, with also support formed here. Just to be clear, guys, there are several ways of plotting SR, which I will go through some of these during the course of this webinar. But for here we're simply locating floors and ceilings of the market and seeing what their reaction was. So the first area of resistance held price lower a number of times, and with the final reaction generating a substantial move lower. This therefore was a clear ceiling to be aware of on the daily chart. The second area was a support base and was, probably a lot clearer on the H4 and H1 timeframes. Nevertheless, we can clearly see this was an area of support buyers showed interest in, and therefore, may do so again in the future should we reach this far south. Okay, now we have a somewhat clearer idea of what support and resistance is, and a general idea of how it forms on charts. Let's swing things over to different types of support and resistance levels that exist. Because we're going to look at identifying different types of SR levels, I thought it would be a good idea to essentially combine the two subjects, so types of support and resistance, and how to plot support and resistance levels. As you know, the two concepts merge pretty nicely. So as most of us here will know, markets ebb and flow. They go up, they go down, and they move sideways. This is pretty basic stuff, and even newer traders will be aware of this. So the way we make sense of these movements are by analyzing the levels in the market where price bounced higher or rotated lower from. So first up, and this is something I believe most of us learn to work with in the beginning, we have traditional swing highs and lows. As you can see from the slide, the pound dollar H4 chart, we can see we can use these swing points to extend potential support and resistance into the future. You will find that at times price will return to these previous swing highs and lows and hold. This is actually where most SR levels originate from. For those newer traders here, swing highs and lows, they can be easily spotted on all time frames, from the 1 minute chart to the right up to the monthly time frame. So a swing high, excuse me, is the peak that price reaches after a movement higher, before it prints a retracement. This move higher into the swing high is an important level and is often used by traders to hunt reversal setups or as profit objectives. A swing low is essentially the same as a swing high, but inverted. With a swing low, price will essentially swing to a low point. Swing to a low point before moving higher or pulling back to create the swing low. Just one second. Just give me a second, guys. 1 second. Excuse me. Okay, many of us here will associate swing highs and lows with uptrends and downtrends, and this slide shows a very clear uptrend on the pound dollar, which has been going on for quite a while now. Most of us here, okay, I guess some of our newer traders may also be wondering how we determine a swing high or low. So without waiting for a truckload of candles to form. So one particular technique that I often employ is the pivot point reversal. This has nothing to do with floor trader pivots, you know, the R1 resistance and S1 support type of thing. So the word pivot actually means the point at which things turn. So essentially, what we look for on the charts are V-shaped reversals, right? Take the example on the slide, a zoomed in snapshot of a swing high from the previous slide. And this is what's known as a bearish pivot reversal. Note we have reasonably defined bullish moves to form the swing high. It is at point 1 where we see a high form like all the other highs previous, followed by another high at point 2. Which, you know, at this point we still don't really know if it will be just another high or a defined swing high. But you know, at point 3, this confirms we have a bearish pivot reversal in hand by the close under candle 2. Though, you know, as I said, there's no right or wrong here, but to be on the safe side, especially for traders using these patterns as confirmation to enter a trade, they'd likely look for further confirmation in a close under the low at candle 3. So in this case, point 4 was the one we were looking for to sell or to further confirm the swing high. For a bullish pivot reversal, it's simply the same as a bearish setting, just you know, it's turned on its head. Excuse me. Guys, there are a number of ways I believe traders use to define swing high and low points, and this is just one of them. And you know, I've only just briefly covered this. It's just a pattern I prefer, and that's proven most consistent at defining swing highs and lows. In fact, if you're interested in seeing this in action, you should consider hopping over to FPM's Trading Hub to view Gary Burton's weekly analysis. He uses bullish and bearish pivot point reversals a lot in his analysis, so it's certainly worth checking out. Okay, now we have an idea of what swing highs and lows are, and that they can form possible support and resistance. We must be aware that traders don't only stick to candle extremes. So what I mean by candle extremes are the upper shadows and lower shadows, the highs and lows of the candle. So basically, they don't only stick to the candle extremes to help form support and resistance from swing points. They also include candle bodies. So as demonstrated on the slide, we have a number of swing high and low areas. They help give your trade some breathing space should you wish to try and, you know, fade the swing high and low zones. This is actually quite a common technique traders use. In fact, I know of some traders who look for bullish and bearish pivot points to form off of these areas as for potential trades. You can actually see a bullish pivot point formed at the beginning of November, shown by the blue arrow, which with prudent trade management could have been a whopper of a trade. You know, this is very, very simple stuff, but you know, keeping it simple is what I really adhere to, and it seems to produce the most consistent results. So moving forward, let's now look at trying to bring some of this together on the charts. So on the slide we have the euro-dollar daily chart, which I've applied a clear area of resistance that lasted right from early 2015 until it was breached in mid 2017. I know the area held price lower on 4 occasions, but as you can see, it failed to deliver on the 5th test. The key thing to note here is what happened following the breach. The area was retested as support at points 6, 7, 8, and 9, which all held firm. So this is an area buyers will be looking to form long entries. A common technique traders use called the break and retest approach. This is especially popular in trending markets. So imagine in the case of an uptrend, we break resistance, and we can then monitor the charts for a retest of the broken resistance as support. So as you can see, the resistance area is not a defined point. So say it's not 1600, it's not 1620, for example. Traders often form zones around support and resistance levels in attempt to catch all the, how can I put this, all the major swing points, all the major points of resistance. So on the resistance example shown on the slide, we've caught all the major turning points. And we've extended this area into the future. What this does is it gives you an area or a zone to focus on rather than a level, and also provides a defined base for stop loss placement, as shown for buyers entering long from the resistance turn support zone. Now, just to be clear, guys, you don't actually have to set your stop loss around this area. If you can go down into the lower, so knowing you're at a higher time frame area, you can normally drill down to the lower time frames to find, you can even look for lower scale support and resistance and set your stop loss via that. You don't always have to position your stop loss below the higher time frame area. It's just knowing that you're in a higher time frame zone, and the likelihood of price rising from this zone is reasonably high. But as you can see, there are a lot of whipsaws, and on the lower time frames, these could be quite painful. So just bear that in mind as you go forward. The same can be said for a resistance area, right? Extending the same area used in the previous slide into the future help provide a resistance structure to work with at points 1 and 2 when the support was breached. And then again, once the resistance area was breached and retested as support at points 3 and 4. Now, if you recall, this was from the previous slide where a double bottom formed. So what we have is an area that has, it's provided support and resistance since 2015 to this day. All right, this is a long-term zone, but this can just as easily be applied to the lower time frames, or even blended together, approaching the market from a multi-time frame standpoint. This is something I'll be looking at near the end of this presentation. Guys, look, I hope what I'm showing is clear, especially for newer traders. If not, please feel free to question anything, or if you prefer, fire across any questions to me at marketanalyst@fpmarkets.com.au. Okay, so next up, we're moving to, just give me 1 second, guys. So we're moving to a concept known as the Quasimodo pattern, which I use a lot in the daily and weekly market analysis. So guys, do any of us here use these formations, and has anyone found success using them? If you could just type in the chat box, that would be great. So Okay, so we have quite a few here using QMs. Excellent. Okay, we haven't tried these before. So no problem at all. Right, so what I'll do is I'll go over this as much as I can without confusing any newer traders. So the Quasimodo pattern is it's not really well known. It's not really a well-known way of determining support and resistance, despite there being quite a few articles written on the formation. I think the confusion might be because the Quasimodo is also sometimes called the over and under chart pattern, or simply a malformed W or M pattern. For me though, I simply see it as a simple fake out setup. So we have a bear trap for bullish Quasimodo patterns, and a bull trap for bearish Quasimodo patterns. As its name implies, a failed downside breakout is called a bear trap, while a failed upside breakout is called a bull trap. It essentially traps. So look, it essentially traps breakout buyers and sellers, right? There's nothing really more to it. Excuse me. Than that. So it essentially hunts the stops below the. So it hunts the stops above this swing high here and this swing low here. The sell stops below here. The sell stops below here and the buy stops above here. So the structure of the Quasimodo pattern is relatively straightforward. In a market moving higher, you'll see higher highs and lower highs forming. Once the higher lows, once one of the higher lows, should I say, are penetrated, you're then working with a potential bearish Quasimodo resistance level, which is found by extending the level from the left shoulder. A level that's now tradable should price return to this base. And guys, it's exactly the same for a bullish Quasimodo formation. Over the years I've been using this pattern, I feel it's certainly a top way of determining support and resistance if positioned in the right location. So what I mean by the right location is either within an uptrend for the bullish Quasimodo formation, on a dip or retracement, or within a downtrend for a bearish Quasimodo formation on a pullback. We can also look for these areas within, as we previously discussed, support and resistance areas. So for instance, if we have a bearish Quasimodo pattern forming in a resistance area, preferably a higher time frame resistance area, this can be a nice way of confirming the resistance zone. And generally people look to enter at the left shoulder with stops tucked above this high. However, you can also, for more conservative traders, you can look to the left to see if there are any, how can I say, any resistance zones above here, and potentially you can place your stop above the resistance zone. This helps avoid any whipsaws, which can, as I demonstrated earlier, can occur in higher time frame zones. Okay, so on this slide, I believe it's the euro-dollar H1 chart. Excuse me. So the euro-dollar H1 chart, I cherry-picked a couple of reasonably nice Quasimodo formations to show you what it looks like on a real trading chart. I won't go into too much detail here, but what we have is a bearish Quasimodo, which formed within a downtrend on a pullback. We hit the so we where am I? Oh, so yeah, we also have a bullish Quasimodo pattern that formed after breaking this swing high here and delivered strong support on price returning to the level. Now, as you can see, guys, these are sometimes pit perfect reactions, and then sometimes they just fail. However, here you would have had your stop below here, so you would have likely been able to get out at break even. Also, just to add, some people, I've seen a lot of people actually take these. So when you have these levels and it's probably better here. So when you have these levels and they extend through here, there's normally a small surrounding, so a supply. I know I haven't gone over that yet, and I'm sorry if I'm confusing people here, but there's normally a supply area here. So normally people try and enter at that supply and place their stops aggressively just above that area. So as you can see, a pit perfect reaction like this with a tight stop can really produce some seriously healthy risk to reward, especially in moves such as this. So yeah, now guys, look, we also have two other bullish Quasimodo patterns, as I've already noted here. So now guys, as this is a basic introduction, I've purposely not gone into too much detail with this pattern, but do be aware these formations can serve they can serve really well as support and resistance, also when breached as well. So as we discussed on the previous slides regarding support and resistance zones, these levels, once breached, can actually perform fantastically on the retest. So for instance, if we have a clean break here, I always look for a clean break, to be honest. I don't want to see any action form here. So a clean break, you can always look and make sure it's broken the low of or the extreme of the pattern, and then we can look for a retest on the at the underside, in this case, of the level. Also, guys, look, you should always look for confluence. Don't just trade on these as a sole way of making your trading decisions. I would always look for other confluence to increase the odds of a trade working out. So, okay, now we're gonna change things up slightly as next on the scale are what traders call dynamic support and resistance, formed by moving averages. It's also worth noting that moving averages can help decipher trend direction, but this is for another webinar. I won't go into the calculation behind the moving averages, but just be aware that the most the common form of moving averages are the simple moving average, or SMA, and the exponential moving average, or EMA. So typical settings for moving averages are anything from 20 periods to 200 periods. What I mean by periods is simply the number of candlesticks used. So on the H1 chart, a 20 period moving average refers to the previous 20 candles or 20 hours. A 200 day moving average refers to the previous 200 days or 200 previous daily candles. So as seen on the slide, we have a 200 period moving average. This is a simple moving average, which is fixed to a previous chart shown earlier in this presentation. The pound-dollar H4 chart. So the moving average actually it converged with a retest of a couple of swing low points. This is what I was saying when I said look for confluence. So for here, if we were to trade here, for example, don't believe it actually hit, but imagine price actually hit this area. We have confluence of not only a swing low support area, we also have confluence of moving average support. So look, I really don't want to spend too much time on this, but the main idea I want you to take away from this, guys, is to keep an eye on moving averages, whatever settings you use, as they can and often do serve as support and resistance. Right, okay, we're on to the last segment of the presentation, namely multi-time frame analysis using support and resistance. Now, I know some traders may already use this, and will probably use a similar or even a different approach, which is great. And just to be clear, traders, this is not really multi-time frame analysis. Is not really what I would call basics, but I believe a basic introduction to this concept may set a good foundation to develop as a trader should you wish to include multi-time frame analysis in your trading. So for my analysis in for my analysis in FP markets, I focus on the monthly, daily, H4 and H1 timeframes. I use the monthly and daily timeframes for more of a longer term projection, and the H1 and H4 charts to gauge the shorter term direction. Of course, some traders may prefer to add in the weekly time frame instead of the daily time frame, and some may even prefer to shoot down to the M5 and M15 time frames, and that's absolutely fine. That's the great thing about trading. We're able to maneuver things into a system that we personally feel comfortable with. So if you bear with me just a few seconds, I'll quickly spin things over to the market analysis charts that I use. Okay, now I assume you can all see this dollar yen chart. So yeah, I have to say that the analysis that I'm about to show you contains other technical tools, not just support and resistance. So I will try to work around this as best as I can to only show you how you can. This is basically to only show you how you can work with multi-time frame analysis. Okay, so on the dollar yen chart. Okay, we have a question. Is there? One second, guys. Is there any way to get information on how many people are using moving averages on their charts, as statistics show? As the statistics of how many people are looking at specific. I'm not sure about that, to be honest. I know they're very, very popular, moving averages. So I'm not sure if there's any data, but I know they're very, very popular, especially moving average crossover strategies to enter a trade, and as I said, moving averages to define the trend. But for me personally, you can define a trend with price action. I hope that answers your question, Riley. Sorry, I couldn't be of any more use with that. So back to the dollar yen chart. Let me just go this one. So following January's bullish engulfing candle. Formed in, this was a textbook bullish engulfing pattern, by the way. Price action printed further outperformance in February. So look, we're on the monthly scale here, so this is really long-term stuff. So descending resistance here governs the spotlight to the upside, while support around 101.70 is seen below. So from the monthly time frame, we know we could possibly we're likely to continue rallying, in my opinion. So on to the daily time frame, supply at 107.58, 106.85. A base that was welcomed at the beginning of the week, has so far proved ineffective, despite the shooting star candlestick pattern that formed a couple of days ago. So onto the H4 scale, with we can see buyers are clearly still at the wheel here. There's no clear resistance, and this perhaps swings the pendulum towards a fib resistance cluster between 107.47 and 107.37. This is a zone that's complemented by a Quasimodo resistance, which I will show you once we move to the charts. Aside from Tuesday's low around this point here at 106, I believe 106.67, support is not expected to make an appearance until around the 106.11 area. Now, the reason that I believe this is because if you look here, demand, I know I haven't gone over demand here, guys, and I'm sorry if this confuses newer traders, but demand looks incredibly weak here. You can see all the lower shadows. As we're rallying, price stabs lower to consume buy orders. So I see this as a reasonably weak area here. So on to the H1. 107 represented the 107 figure represented a key base on Wednesday, holding back upside attempts. To the downside, trendline support is seen, and the 100-period simple moving average. You know, well above 107, there is a Quasimodo resistance at 107.18. Again, I'll show you this, guys, if you're interested when we flip to the live charts. So from all of this quick analysis that we've just done here, so together with the monthly price showing room to take on higher levels and daily supply at 107.58, 106.85, echoing a, shall we say, a reasonably fragile tone, H4 is likely to make a run for the fib resistance cluster at 107.47 and 107.37. So with this in mind, we can say that this analysis signals H1 is likely to likely to overthrow the 107 figure, and also potentially even the Quasimodo resistance from 107.18, potentially triggering a short-term bullish theme to, I would say, to at least here to the 107.50-ish range. Excuse me. If I can just switch over to the, I believe, the pound-dollar chart. Guys, can you just confirm that you can see my the pound-dollar chart on the screen? Just quickly flick in yes or, brilliant, thank you. Excellent, guys, thank you. So yeah, just going through the pound-dollar chart. So as can be seen from the monthly chart, the pendulum firmly swung in favour of buyers following December's advance that stirred major trend line resistance. We're talking decade-long trend line resistance here. And also February followed through to the upside and refreshed 2021 highs. This is levels that's not been seen for 3 years. But so I'm trying not to go overboard here because I don't want to confuse newer traders. So okay, but despite we have a major trend line breach, which will ultimately excite many buyers, I would say long-term buyers, we primary trend structure for me personally reveals the trend has faced lower since early 2008. So it's unbroken until 43.76 gives way. This is an April high of 2018, I believe. So given February's movement, the 43.76 represents the next upside objective on the monthly scale. Just be aware we're looking at the monthly time frame. This is real long-term stuff here. So okay, so moving down to the daily time frame. So we've seen limited change over the last week, forming back-to-back, indecisive candles. Last week, the previous week established a top a few pips south of Quasimodo resistance at 42.50. This is something I highlighted in a recent analysis, and this prompted a sharp slump heading into the latter part of the week. And also note we formed a shooting star pattern. This is a bearish candlestick formation, generally found at peaks. Support on this time frame is around 37.55, and it's now in the firing line, a level that shares space with a trend line support. Okay, so on the H4 scale, Wednesday left behind a somewhat muted tone, producing little to get excited about. Support at 38.52, and it remains a talking point on the H4 scale. Also technically noteworthy is demand penciled in at 37.61, 37.89, and the trendline support term resistance fixed here. I'm trying to go through this as quickly as I can, guys, so I want to get in if you have any questions at the end. So okay, on the H1 scale, bids and offers were reasonably consistent in recent trade, generating a narrow range around the underside of the 140 key figure. 139 shines bright as a possible support, and with further bearish attempts to potentially retest Quasimodo supports at 38.47 and 38.61. Now, guys, this is something else you could take away from this, and I'm sorry if I confuse newer traders again. We have a round number, so we know round numbers attract orders, right? We know that there's a ton of speculators wanting to buy here, wanting to sell below here as a breakout trade. So if you see a Quasimodo support hovering below a round number, it can at times whipsaw through the round number to take out the stops and trade off and hit bids off these Quasimodo supports, as it did here. I actually noted this in previous analysis to watch out for this. So look, we broke here, we retested this level to gather sellers, right? Only to hit this Quasimodo resistance and squeeze out all those sellers. These are perfect areas to help facilitate fake outs beyond round numbers and also beyond support and resistance zones. So if you see these hovering around these areas, do take note of this. So from here, so for observed levels, so after all this analysis, we can, on the bigger picture, monthly suggests we have room to approach higher levels, right, over the coming weeks until reaching the 43.76 top. Before this occurs, though, a retest of daily support at 37.55 and intersecting trendline support could be on the cards. A move like, this would, given we know on what we know on the monthly time frame, this would be a retest to this area, would be a move likely welcomed by dip buyers, especially longer term dip buyers, and considering the trend has been higher since, I believe, March of 2020. Right, so let me just give me a second, guys. So, I mean, I can spin over to the live charts real quick, just to show you what actually occurred, just real quick. So this is the dollar yen, what we spoke about recently, just a minute ago. We said, let me just look at my notes. So yes, so what has happened here, 107 did in fact give way along with the Quasimodo resistance. Because we noted that this was a reasonably fragile area of supply and there was room to approach higher levels on the monthly scale. Now, as you can see, we're approaching Quasimodo resistance on the H4 scale. So there are likely longer-term buyers, short-term bullish scenarios forming here. What would be fantastic would be a retest of this Quasimodo resistance, which is more than likely support to form support for an intraday move up to Quasimodo resistance. Now, guys, I must be clear here that that this is only my personal opinion and should not be taken as investment advice. So on the pound dollar, I don't believe we've seen much movement. So still on the pound dollar, we've not really seen anything to really get excited about at the moment. So I believe. So now we're okay, guys. Do you have any questions? Let me just fire this back over to here. Okay, so guys, are there any questions? Okay, would horizontal levels considered more or less reliable than diagonal trend lines? Oh, I've just lost your question. So I have a question here. So would horizontal levels be considered more or less reliable than diagonal trend lines? I prefer, Riley, I actually like both of them, both methods, especially when they converge, as you saw on the pound US dollar daily chart. We have the support and trend line resistance combined. But on the pound dollar, if you look, just take a look, guys, on the pound dollar, the trend lines, I mean, when I talk about trend lines, I mean traditional trend lines. They really work well. They really do perform a great bounce on the pound dollar, and it's very, very high probability. But for me, horizontal levels are more reliable, I believe. For me, this is just my personal opinion, but still, I will always include trend lines in my analysis. I hope that answers your question, Riley. So we have another question. Do Quasimodo patterns work counter trend? Yes, they do. However, additional confirmation is normally required. As you're effectively going up against the trend, the confirmation could be something as small as a candlestick pattern, for example. So if you're trying to short a bearish Quasimodo pattern, you could look for a bearish candlestick formations. Also, remember that should we break a Quasimodo resistance in an uptrend, a retest of the level as support could be something to watch out for as you're then in line with the trend. Another question, where can we contact? As I said at the beginning of the webinar, you can use the market analyst at fpmarkets.com.au. This is the best email as both support support and research have access to this. Don't believe there's any more questions. Okay, is there a recording? Yes, there is, and support will contact you following this presentation. Or as I said, you can find these on the FPM website or on FPM's YouTube channel. Now, one more question I see. Would you recommend demo trading? I would, most certainly I would. It's a great way to familiarize yourself with the trading platforms and also familiarize yourself with your trading strategy. I would always personally recommend that for sure, yes. Okay, I don't see any more questions. So, unfortunately, I think this is all we have time for today then. So I sincerely hope, we have one more question. 1 second, guys. How do you place support or resistance? Take, for instance, I want to apply support on the H1 time frame. Do I place them on the highest time frame of simple on the H1 time frame? How do you place support or resistance? Take, for instance, I want to apply support on. So look, how do you place support and resistance? I'm going to try and read the question now. How do you place support and resistance? Take, for instance, I want to apply support on the H1 time frame. Do I place them on the highest time frame of simple on the H1? So if I understand the question correctly, for me, I would always place H1 resistances or supports on the H1 time frame, and then focus on the higher time frame support, their respective higher time frame support and resistances. So I would never try and place a H1 support or resistance on a daily time frame. I'm not sure if I'm understanding the question right. So I would always use support and resistance for that, for that time frame for the H1. I'm not sure if I'm making much sense here, but so for instance, on the daily time frame, I would only use daily. I would never try and place H1 support and resistances on the daily time frame. If that makes sense, I hope it does. How do you draw red Quasimodo line on the last H4 chart? Would that be the pound, Riley? Was that the pound dollar or hold on, how do you draw the last Quasimodo line on the last 4-hour chart? I believe that's the Quasimodo. All right, I'll try and spin this around. Just give me a sec. Just give me a few seconds. I'll spin this around to the. So I believe you're talking about. No, you're probably not talking about. You're probably talking about the dollar yen then. Ah, this one. I would assume you're talking about this one. Let me just spin the. Guys, I hope you can all see my charts. Otherwise, I'm talking to myself. So here we can see the Quasimodo resistance at 107.44. So how I got this was quite simply here. This area here. So we have the high, we have the low, we have the high, the fake out, and then we have a continuation lower. Now, just to be aware, so if price had formed it, as it did, it formed this high, low, high, and if price had come below this low, which it did, and tagged this line, this Quasimodo would not be as fresh as it was. Now, if you can see, this level is reasonably fresh. So look, we could also use this level, this left shoulder here as well. So we could also ping across 2 levels. I was just being conservative and taking the broadest left shoulder here. I hope that answers your question, Riley. And if I just spin it across to as you can see, zoomed out chart, Quasimodo left shoulder, spinned across to the extended to the future. What is the difference between demand and supply and support and resistance? Good question. It depends. It depends on who you ask about this. But for me, let me just see this. So for supply, I will always be looking at areas such as this here that don't really have much history, if that makes sense. So we form a base, we have a reaction. This is a supply area here. This is not something that extends right back into the past, which is what I would consider a support and resistance level. So for instance, this is supply for me here. We form a base at this area. I hope you can see this, because let me zoom in actually. So we have a supply here which reacted. This is all I need for supply. I don't need anything in the past. But for resistance, support and resistance, you can look at things like this. So look, we have resistance, resistance, break, break, retest of resistance here, and a retest of resistance here. So what I mean is there's a lot of history normally with the support and resistance areas, but with supply and demand areas, it's normally more recent price action. I hope that answers your question. Okay, is a Quasimodo pattern a different pattern from a head? Good question. That's a really good question. It is a little bit different, yeah. So as I wasn't going to mention this, but as you can see, so we have I believe, I'm just trying to find a way of explaining this without confusing people. So here we have you know what, let me leave that for another webinar. I'm not sure if I can explain that clearly without confusing people. It is very similar. Is a Quasimodo pattern a different pattern from head and shoulders pattern? It is. They are very similar, but they are different. So the difference is, let me just try and draw it actually. So the difference is we have a Quasimodo pattern here. All right, we have this, we come down, and then we can potentially trade the left shoulder here. Excuse my artwork, guys, I'm trying my best. So we can have the Quasimodo resistance there. Now, with the head and shoulders, we have this, we have the left shoulder forming here, and then we have the head forming here, right? I'm trying to think actually, I rarely use, right, so hold on, we have the, yeah, and then we have the left shoulder, oops, right shoulder, sorry, excuse me, right shoulder forming here. So the difference is where do we enter on the, you know, I've actually forgot where, oh, we enter on the break of the neckline, don't we? We enter on the break of the neckline. So instead of, we don't really want to see, so our head and shoulders, we don't really want to see, we need a clear neckline, don't we? So here we can see that we didn't actually break the low here. Yeah, and we also enter on the neckline break, right, with the head and shoulders. Yeah, thank you, Ivan. That's brilliant. That's what I was looking for. That QM does not have a right shoulder. Thank you very much. That's what I was trying to explain. That's brilliant, Ivan. Thank you very much. So a QM does not have a right shoulder. It only forms a right shoulder after the pattern completes, but it's a malformed head and shoulders, if you will. Okay, guys, I think that's, I hope I haven't confused anyone too much. So I sincerely hope newer traders were able to walk away from this presentation more knowledgeable. I'm sorry if I've kept you too long. So coming up, we have a webinar on price action, a beginner's introduction, on Tuesday, March 9th, followed by an intermediate webinar on the stochastics oscillator on the following Wednesday. So please be on the lookout for those. As always, if there are any specific topics you would like the team to talk about, please be sure to send in your suggestions to, as I said, marketanalyst@fpmarkets.com.au. Also, do make sure to register for the FP Markets Telegram channel to get instant updates. The sign up tab can be found on the lower left part of the FP Markets website. So, okay, on that note, thank you all so very much for taking the time out of your day to be with me and attend the presentation. I really, really hope you took something away from it. So yeah, have a great day, guys, and I'll catch up with you real soon. Thank you very much.